Good afternoon, ladies and gentlemen, and welcome to the Virgin Wines PLC annual results investor presentation. Throughout this presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time using the Q&A tab situated on the right-hand corner of your screen. Please just simply type in your question and press send. The company may not be in a position to answer every question it received during the meeting itself. However, the company will review all questions submitted today and publish responses where it's appropriate to do so. These will be available via your Investor Meet Company dashboard and will notify you by email when they're ready for your review. I'd also like to remind you that this presentation is being recorded. Before we begin, we'd like to submit the following poll, and if you'd give that your kind attention, we would be very grateful. And I'd now like to hand over to Graham Weir, CFO, and Jay Wright, CEO from Virgin Wines. Good afternoon.
Hi, thanks very much, Mark, and thank you all for coming along and attending and listening to what we have to say today. Just to make it a little bit nicer for you all, we're actually just going to turn cameras off during the actual presentation itself. We'll put them back on again for the Q&A at the end. So if it's okay, we'll kick straight off. So just a bit of a summary of the year and a few highlights to start off with. But following a marked period of growth at the end of our 2020 financial year, we've been delighted that we've continued to maintain that momentum through our 2021 financial year. Group revenue has increased 30% to 73.6 million, and adjusted EBITDA increased 45% to £7 million, both ahead of our original market guidance at the time of the IPO in early March. Gross profit increased by 36% as we continue to benefit from expanded gross margins, whilst we continue to convert cash at a high rate whilst maintaining a tightly managed balance sheet. Our customer base has increased by 24% over the past 12 months, with all our core trading channels benefiting from substantial year-on-year growth. One of the challenges we were rightly given during the IPO was whether we would continue to see loyalty from the new customers that we acquired over the lockdown periods. So it's pleasing to be able to report that these customers, 18 months on, continue to perform at a significantly higher level even than our historic norm. Indeed, customers acquired in FY20 have delivered an average of 79% more revenue each than recruits in FY19 and have delivered 87% more gross profit each. A sales retention rate of 113% is testament to the loyalty and engagement of our customer base, both old and new. We've achieved this whilst our people have gone through an immense amount of change to the structure of their lives, both personally and professionally, which makes me hugely grateful and proud of the tremendous commitment, enthusiasm and energy that they've continuously shown. We have a business that's built on solid foundations, that's robust and capable of thriving in a variety of market conditions. We marry the ability to deliver high levels of profitability within a disciplined business model while still being exceptionally ambitious and innovative. So there's a few highlights of the year to date. Graham's now just going to talk through in a bit more detail around the financial performance.
Thank you, Jay. Just to mention very briefly at the start, this is our first set of numbers that we've prepared using IFRS following the AIM listing back in March 2021. We've also retained some non-IFRS measures such as EBITDA to provide like-for-like comparisons with numbers that we'd previously reported. In this presentation, the like-for-like profit numbers or adjusted numbers have excluded the IPO listing fees of 3.5 million, as we're treating these as exceptional non-recurring costs. So highlights of the year overall are the growth in the revenue, up 17 million, 30% to 73.6 million, and a corresponding jump in the profit before tax before exceptional costs of up 2.4 million, 86% to 2.5 million overall. As a result of these, the adjusted earnings per share for the business has increased by 38% to 9 pence per share. There's a number of changes to our balance sheet as a PLC now reporting under IFRS, but I think the key thing I wanted to pick out from this was the investment that we've made in inventory. We started to build up our stock buffer about this time last year in advance of leaving the EU, so that we had extra European wines in before Christmas. We've continued to do this approach throughout our FY21 period, and this year we've brought our Christmas stocks in 2 months earlier than normal to make sure we've got stock in the warehouse well in advance. And this obviously was, we were able to do this because last year we invested in additional warehousing space that came along on stream last November. So we've got extra capacity, and we've used that to build up our inventories going forward. The other thing to note within the balance sheet is that we repaid in full outstanding term loans that were outstanding at the end of last year of £12 million, and the business is now debt-free and just has cash on the balance sheet. There's, as I mentioned just previously on the cash flow, there's no net debt following the IPO. We have invested in working capital, so it's gone up during the year. There was 2 real drivers to that. One was the increasing the stock inventories Ray talked about. We also had a reversal of some payments that had been deferred in Q4 FY20 for the inland revenue, when we thought that the business may have to temporarily close because of the first lockdown. But when we were told that we were allowed to stay open, we basically repaid those by August 20, but we had 6.1 million of extra cash at that time relating to those deferments that has washed out this year. Otherwise, the underlying cash position of the business remains very strong, and our capex requirement going forward in last year is still very modest. This slide bridges the EBITDA that we delivered in FY20 to the 7 million EBITDA that we've delivered in FY21. It's a good snapshot of how our business model works and how we deliver revenue growth and profitability. It starts with our low-cost customer acquisition model. So yes, we will invest more to grow, but following a tried and tested model that we know delivers high quality customers with great payback ratios. We will continue to invest and increase the rate of investment where it is sensible to do so, and we can deliver good returns on those customers. Revenue growth comes from the increase in the customer base, with over 80% of our customers engaged in one of our membership schemes, but also free to select the way they want to interact with Virgin Wines. And this is supplemented by our commercial division and also by our expanding range of gift, beers and spirits. We've also seen an increase in margin, and this is due to good disciplines across the business on our wine sourcing model, which allows us to create great wines at good value that can deliver excellent margins. Our product margins have increased by 3.1 percentage points since FY19 as a result of this disciplined approach. We have invested in overhead and people. The business has grown quickly since FY19, and we've invested along the way in extra capacity, such as our new National Distribution Centre in Bolton that gave us an extra 50,000 square feet of warehousing, and in skills within our teams, particularly in marketing, in IT and buying. These investments are targeted to improve the customer proposition and our service levels. We've also seen PLC costs come in for the first time, so we've just shown those as a separate item on the bridge. There are some extra costs that obviously come with being a listed business, but these are easily outweighed by the benefits of running a debt-free business and with the access we have to the capital markets. And again, this just gives an excellent snapshot of how the business has progressed over the last 12 months. As a result, we're able to grow the business and improve the net margin overall, moving up to 9.5% as a net margin against turnover, compared with 6.3 back in FY19. So what is driving that percentage increase. It's coming from our active and loyal customer base, delivering regular, predictable income and returns and low churn rate on our mature customers. The graph at the top basically shows the revenue split out by historical cohort, and you can see the like-for-like comparisons on the individual annual cohort years and the growth that's now in the business. And it shows a picture of really consistent sales returns from the historical cohorts. And this is what is delivering the sales retention rate of 113%. We're also seeing improving returns on our payback, which is the table on the bottom right-hand side. So we've got our 5-year and our 10-year payback on each of the cohorts that we've recruited in those years. And we've seen progress on that through from FY18 through to FY20. And we've also seen an uplift now in our longer term average, which has gone from 4.1 times for 5 years up to 5.1 times. And our 10-year payback up from 5.8 to 6.5. Just a point to note is both the FY20 and the FY21 new recruits generated a payback of over 2 times after the first year. And that's obviously helped uplift the long-term average over the last 24 months trading.
Great. Thanks, Graham. So just moving on now to the customer base, and core to the business model is acquiring large numbers of new customers, converting them into loyal advocates of Virgin Wines and maximising retention rates. It was pleasing to see a record number of new customers acquired over the financial year, resulting in a 24% increase, and in turn delivering a 1 to 12-month active customer base of 183,000. In turn, we increased our investment in customer acquisition by 11% to deliver this 24% increase, as we took advantage of the demand for direct-to-consumer services to recruit new quality customers at a low cost per acquisition. There are a number of ways we continuously monitor the health of our customer base, and all those indicators look positive. This is particularly key as we've been obsessively tracking any changes in consumer behaviour as the country's gone through an unprecedented amount of change. Conversion rates have increased. Our trade rate, which has been continuously predictable at around the 70% mark for several years, has edged higher, whilst net contribution from the active customer base has grown by 79% between FY19 and FY21, delivering well over £12 million last year. And as Graham's described, the sales retention rate has edged up to 113%, an outstanding level. Our business model is based on driving high quality recruits with a comparatively low CPA, which in turn allows us the opportunity through our unique range of consumer propositions to deliver an engaged and loyal customer base that drives market leading lifetime value. And we're encouraged to see this working so well in practice. Key to this is the success of our 3 differentiated consumer propositions. Our Wine Bank, Wine Plan and Pay-As-You-Go services offer consumers a different set of benefits depending on the preferences of that customer. Just a reminder for anyone who may not know how those schemes exactly work, our Wine Bank service allows customers the ability to spread the cost of buying wine by saving money each month in their Wine Bank account. In turn, they receive £1 for every £5 they save, so equivalent to 20% interest, and free express delivery as standard. Wine Bank is our biggest and most popular scheme with 120,000 members, and that was up 22% in FY21. And delivers 59% of the total revenue contributed by active customers. We have record deposits from Wine Bank customers, around £2.3 million per month, and we currently hold around £6 million of Wine Bank customer cash in a ring-fenced account, which customers will use on future purchases. Our Discovery Club and our Just Reds Wine Plan schemes contribute to 16% of revenue, with the total membership increasing by 6% to 26.6k in FY21. This service delivers outstanding gross margin levels and has low operational costs, but does result in a higher churn rate than Wine Bank, where the annual cancel rate is only 15%. Finally, our Pay-As-You-Go customers deliver 25% of total revenue over the financial year, and have the ability to enjoy anything from the entire product portfolio, from our whole 700 different wines, 350 different spirits, 150 beers, but without the perceived commitment of a subscription scheme, which is an attractive proposition for some customers. The way these different services work in tandem is key to delivering the excellent levels of payback and lifetime value our customers deliver. We continue to invest in driving growth through an aggressive customer acquisition plan, which delivered a record number of new customers into the business. This was done while still maintaining the discipline to deliver new recruits in a cost-effective manner and to ensure the quality was high, something borne out by the increase in the conversion rate to 56%. Recruits over the year came in at a cost per acquisition of £14.09, whilst on the fully costed basis, they were acquired for just £7.74. This has resulted in our FY20 and FY21 recruits delivering over a 2 times payback in just the first year. Our partnership model was key, delivering 63% of recruits, while a range of digital channels contributed 15%. These were supported well through a range of other methods, with the Daily Mail Wine Club, re-recruitment through our CRM campaigns, recommend a friend promotions, and telemarketing, all contributing to the overall total. You can see through the funnel how these recruits flow into one of our different consumer propositions, where we then begin the specific customer welcome journey that gives us the best chance of engaging with our new customers, delivering our brand messaging, and ultimately converting them into being a long-term advocate of Virgin Wines. The business then uses 4 main channels to drive revenue from this active customer base. Our email channel delivered a huge increase in revenue of 39% in the year. This is our largest individual sales channel, delivering over £21.3 million of revenue through a targeted promotional plan that delivers relevant and timely offers regularly to the active base. We operate a fully automated suite of emails that are triggered by a variety of customer interactions, and we've become increasingly personalised in terms of the content delivered and the relevancy of the offer. Our web channel increased revenue by 18%, with all the key metrics positive, including increased traffic, increased customer sessions, whilst maintaining the increased conversion rates we delivered in FY20. Digital marketing through search, programmatic, Google Shopping, native advertising, social and PR all contributed positively to increased awareness and sales, whilst investment in Salesforce through our interactive studio and advertising studio, alongside increased levels of A/B testing, drove improvements in the customer experience whilst continually optimising conversion rates. We continued to invest in our wine advisor team, and we saw sales grow 22%, closely mirroring the growth we saw in the overall customer base. The team continues to deliver an outstanding one-to-one personal service to over 45,000 wine advisor customers, which in turn drives increased customer loyalty, higher average order values, and lower churn. This is a free service to all customers who may find it beneficial. And our wine plan scheme delivers exceptional levels of gross margin, and with revenue 19% up year on year, this was another useful contributor to increased profitability. The wines for our Discovery Club are all selected specifically by Andrew Baker, our buying director, whilst the wines for the Just Reds Club are all road tested and approved with personal tasting notes by world-renowned top wine critic Matthew Jukes, who heads up this great value service. FY21 saw outstanding levels of growth through our commercial channel, with revenue up 73%. Interestingly, this was the one channel that was negatively affected by lockdown, as we lost all the revenue through our travel partners, including Avanti West Coast, LNER, and the various holiday companies we've worked with. Despite these setbacks, the team went about not only replacing the lost revenue, but delivering exceptional levels of incremental growth with an extremely successful campaign with Virgin Money of particular note. As well as the increased revenue, the channel also delivered 199% to 1.2 million of additional net contribution. We believe there's substantial headroom to increase our presence in this area of the market, leveraging our core competencies of buying, new product development, fulfillment, and logistics, with a focus on all year round ongoing relationships. As part of this growth plan, we're delighted to have struck a long-term partnership with Moonpig. This venture launched in September, and we're optimistic about the opportunity this, alongside many other potential new partnerships we're discussing, can bring as we aim to continue to develop this channel. The online gift market has seen significant growth in recent years, and our ability to source and deliver a wonderfully curated and beautifully packaged range of gifts, again, fits perfectly into our core competencies. Increased investment in digital marketing has helped drive a 75% increase in revenue, whilst net contribution increased 107% to £797,000. We had a particularly successful Christmas period with record sales from our Advent calendar campaign, as well as increased demand through our regular gift purchases, as well as through our Amazon shop. Just out of interest, we actually also have 90,000 customers on a separate base who've ordered gifts from us in the past, which is separate to our core wine base. And that's also a great feeding ground for our core business. We successfully launched an automated gift reminder service on the website to remind customers of forthcoming occasions earlier this year. And we've partnered with Virginia Hayward to offer customers a wonderful selection of hampers. The next development for the gift channel is to offer a fully personalised label service, and that will be launched in the early part of 2022, alongside an exciting new partnership with a direct-to-consumer flour provider. When we first launched our beer and spirit range, it was on the back of extensive research that suggested many of our customers also purchased from those categories. We've been pleased with the growth we've seen, with a near doubling of sales in FY21, and this has led to the development of 2 new services that launched pre-Christmas, Beer Save and Spirit Save, and that allows customers to save monthly, a la the Wine Bank scheme, and receive beneficial pricing. However, the most potential from this comes from our existing customers, as any customer currently on one of our subscription services, so our 150,000 customers who are on Wine Bank, Wine Plan, or our Beer Box scheme, automatically receive that preferential pricing, which we believe will encourage a significant increase in sales to our existing loyal customers, going back to the original reason for launching these adjacent categories in the first place. The development of our exclusive range in both product portfolios continues to track ahead of schedule, with over 40 products now successfully launched. We have an exciting growth plan for both exclusive beers and exclusive spirits in place for the next few months. Given the growth of the business, we knew we'd have operational challenges in Christmas 2020 if we didn't increase our capacity. So we were pleased to add a new 50,000 square foot fully bonded warehouse in Bolton in the autumn to double our operational capacity prior to our peak trading period. This increase will allow us to add 50% more volume to our FY21 levels, with the capability of dispatching 1.5 million cases per annum. This is particularly opportune given the current news around limited warehouse availability, so we're pleased to have future-proofed ourselves when we did. All operational functions, with the exception of the delivery to the customer, are handled internally, which ensures the highest standards are maintained whilst maximising efficiency and productivity. We've also added a second backup courier as an insurance measure to ensure we don't have a single point of failure with any third party. We're planning to introduce a new warehouse management system over the summer of next year, which will replace the current warehouse management system, which, whilst still more than adequate, it's been operating with us since 2000 and is probably in need of upgrading. Outstanding customer service continues to be a priority, and we're pleased to be rated excellent on Trustpilot from nearly 20,000 reviews. It would be amiss of me not to talk about the outstanding winemakers we work with around the world to create our exclusive wine portfolio. Whilst we have the ability to make our wines anywhere, we also have over 40 trusted long-term partners who we work hand in hand with and who embrace the opportunity to create wines informed by our customers' tastes and feedback. Here's just a small selection of those winemakers, and the story is a similar one of wonderful long-term partnerships and a common belief that we can create better tasting wines and superior value for money by listening to our customers and blending specific components to deliver more than the sum of their parts. Listening to our customers isn't only about the wines, it's about everything we offer. And whilst we know we always have room to improve, and we strive to do that every single day, we also know there's a lot we're getting right, and our customers tell us this on a regular basis through Trustpilot reviews, face-to-face interactions at our tastings, and in fact, we just held our first post-COVID tasting in London in early October with 1,000 customers coming along, and then through our suggestions at email address. But what's great to hear is the continued themes that keep getting repeated, that customers love the wines, the convenience, the one-to-one personal service of our wine advisor team, our different subscription schemes and especially Wine Bank, and the quality and value they receive. There are a handful of examples which are on the slide there that you can read. We're committed not only to developing a growing and profitable business, but also one that takes its responsibilities to the wider world seriously. There are already a number of initiatives we're committed to, including UK bottling, which reduces the carbon emissions of shipping a bottle of wine by 40%. We also use Greencroft in Durham for all our bottling, and their entire estate is powered by 3 wind turbines, with 40% of the energy they produce going back into the national grid. We also have a rigorous ethos around recycling within the business, the supplier packaging and the boxes we distribute our products in. We're also proud to have partnered with 2 charities this last year, the Drinks Trust and Growing Well, and we're delighted to have been able to support 2 very worthy organisations, both doing hugely important work. We know there is more we can do, and we're committed to doing more. Also, through our relationship with the Virgin Group, we're part of their overarching ambition of having all Virgin business working towards being carbon neutral by 2030. Our most important asset is our people. As it has been for many individuals across the world, the last 18 months has been a challenging time, and our teams haven't been immune from that. Therefore, we've done more than ever to create a safe and supportive working environment. This includes introducing an employee assistance programme, which allows all employees to have fully funded access to independent counselling services, legal advice, and debt management expertise. The full senior management team also completed a half-day training seminar for awareness of mental health in the workplace, run by the charity Mind, to allow us to become more aware of the early warning signs that we may have team members who are struggling in some way. We've also introduced a hybrid working model, giving employees the flexibility to work in the manner they feel is most appropriate to them, for their productivity and their individual circumstances. Our culture and our values are central to delivering the enthusiastic, dynamic, supportive environment we've always strived to create. And this has become more important than ever, with many people working remotely, and it's something we continue to prioritise on an ongoing basis. It would be impossible for me not to mention the many challenges facing UK businesses right now. And while it's impossible to be unaffected by a number of these headwinds, we also believe we're in a favourable position to be able to mitigate against them. It's been a challenging vintage in a number of countries, with frosts in France and poor yields in New Zealand, leading to particularly low harvests. But this is where our open source buy model comes into its own, allowing us the flexibility to secure stocks from any winery or any supplier anywhere around the world. This has allowed Andrew Baker and his team to use their extensive network alongside our excellent reputation to secure stocks from a variety of sources, something many businesses contracted to specific wineries are less able to do. Clearly, there are also challenges around shipping and delays to stock. And whilst we aren't immune to this, we stocked up early and at increased volumes in anticipation of potential supply issues this winter. So we brought in around 20% more wine and 2 months earlier than we normally would to ensure our warehouses are full. And one thing I can tell you with absolute confidence is that we won't run out of wine. Also, our merchandising model is based on our own internal team configuring the wines that go into our premix cases that makes up about 80% of our sales. So we can be absolutely prescriptive around the wines included based on the stocks that we have, irrespective of some wines potentially being delayed. This largely negates any issues around individual SKU shortages, whilst also allowing us to control the consistency of the margin of each individual case created. These factors put us in a great position to be able to mitigate against many of the issues facing UK businesses right now, and we believe places in an advantageous position against other businesses with a less flexible model. So we're now through the first quarter of our new financial year. We've all been watching consumer behaviour over the past 6 months to try and understand every potential change now that hospitality is fully reopened and life has reverted back to a much more normal pattern. The first thing I'm encouraged by is around any concerns of the loyalty of the customers we've acquired over the lockdown periods. These customers have proved to be even more loyal, and concerns over the stickability of these customers has proved unfounded, with the long-term 5-year payback rising to 5.1 times from 4.1 times. And it's this loyal, growing customer base that continues to drive our growth. I believe that the hard work we've put into customer engagement and adding significant value over and above that of the transactional e-commerce business has made us more of a lifestyle brand to our customers, a part of their world, and hopefully a good part that they don't want to give up. The fact we also have a customer base that's highly biased towards subscription services leads to highly predictable levels of future revenue. So 80% of our 183,000 active customers are on one of our subscription schemes, and this has been key. This has led to a solid start to our new financial year, with revenue for Q1 13.3% up year on year, repeat revenue up 16.1% year on year. And although new customer acquisition has undoubtedly become more challenging, we're still recruited 10.7% more customers this quarter of this year than we did in last year. I'm also pleased to say profits are in line with expectations at the end of our first quarter too. As already mentioned, we're well placed to mitigate against stock shortages or supply delays through our open source buying model and pragmatic approach to merchandising. And whilst we acknowledge there are headwinds, we believe our robust, disciplined business model is well placed to cope when market conditions are less favourable, as well as being able to take advantage of opportunities when trading conditions are more positive. We're therefore confident in our prospects, and we still expect our current year trading performance to be in line with expectations. Thank you very much.
Jay, thank you very much. And also thank you to you, Graham, as well, for updating investors this afternoon. Ladies and gentlemen, please do continue to submit your questions using the Q&A tab situated on the right-hand corner of your screen. But just while the company take a few moments to review those investor questions submitted already, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your Investor Meet company dashboard, and we will send you an email when they are ready for your review. I'd also like to remind you that your feedback is important to the company, and immediately after this presentation has ended, we'll redirect you for the opportunity to provide your feedback in order that the company can really better understand your views and expectations. Graham, Jay, that's no time at all to look at the questions that have come in during today's call. So if I could ask you to open up the Q&A tab. Obviously, we had a number of pre-submitted questions, and you've received a number through the meeting itself. So thank you to all of those that have taken time to submit questions. But if I could just ask you to perhaps read through those questions and give a response where it's appropriate to do so, and I'll pick up from you afterwards.
Yeah, no problem. I'm literally just trying to look through some of the questions right now, but I'll start with a couple of the ones which were submitted beforehand. So yeah, good question. Why is your share price drifting lower? I don't know is the answer. We actually believe that we've delivered a really good trading performance for this last financial year. We've overperformed on our top line and on our profit from what the expectations of the market were at the time of the IPO. Businesses continue to trade really well through the first Q1 of this year. So yeah, we think we've got a great business with great prospects. So yeah, I'm not sure why. I think we have had a little uptick today, which has been nice to see. But hopefully we can convince many more of you to come and support the business. So just moving on to the next one. In light of Brexit and trade deals with Australia and New Zealand, can we expect better value from these regions? Yeah, I think that the answer is yes. It's one. So CCT, which is the tax which is charged on imports from what used to be outside the EU, is a one factor in the cost of goods. So obviously there's lots and lots of different things that affect the price of a bottle of wine from Australia or New Zealand, largely vintage and yield orientated. But there is definitely going to be a cost advantage by the CCT not being part of that anymore. So yeah, hopefully we will see better value from both those regions. And the next question was, can you see UK wines improving in value as volumes increase with maturing vine stock? I'd like to drink more, but the price is currently too high. I think there's some great wines being produced here in the UK, and I think English sparkling wine in particular is very deservedly got a great reputation. I I think the main factor around the price of wines is just land is very expensive in England, and so the amount of vines that you can plant on an area of land is finite, and therefore the yields that you get related to the cost of that land ends up being quite high. So I don't think that will change. I think what will change is that obviously I'm sure that everyone's seen from the budget yesterday that there's going to be some advantageous duty rates for sparkling wines. So that should in particular help the English sparkling wine market. And I think as the vines do mature and you get more yield off the vines, then you should start to see prices come down a little bit as well. But there are some great English wines out there. I thoroughly recommend you checking them out. So how have customer behaviours changed since lockdown restrictions lifted? I think hopefully I've answered this during the presentation, but not much is the answer, which is what we always said is when our job during lockdown period, when lots of people came and tried buying wine from us for the first time, what we had to do was convince those people that whatever they used to do, buying from us was a better way of doing it, and convincing people of the quality, the value, the outstanding service, creating that engagement and creating the relationship with people. So, you know, as I've said, we're not a transactional website where people come and just buy a bottle of wine. We create real communication and engagement with people. And I think having created that engagement and shown people the great quality and the great value that we can deliver, they've stayed loyal following on from those lockdown restrictions lifted. And whilst it is great for all of us, and absolutely myself included, that we can go out and have a drink at a pub and a meal at a restaurant again, and I'm certainly enjoying the ability to do that too, I think people are also still really enjoying socializing at home, being able to spend some time with friends and family again. And I'm sure with last Christmas being affected really badly by the restrictions, I'm sure people are looking forward to making the most of this Christmas with friends and family, and I hope that lots of bottles of virgin wines will be accompanying their celebrations. Just moving down to how is the Moonpig partnership performing, and should we expect any other similar partnerships or deals? Yeah, the Moonpig partnership is something we've been working with them on for a few months. Both themselves and ourselves are really excited about it. We think there's great opportunity to expand significantly on what we're doing with them at the moment. Business from their perspective on the wine range has started well above their initial expectations. So everyone's really confident about how this is going to progress. And yeah, we're really excited about it. And absolutely, we're always looking at similar partnerships. And I think I mentioned we've got a tie-in with a direct-to-consumer flower business, which we're not far from going live with, which is another great partnership that we're looking to launch soon. So yeah, great partnership with Moonpig, and thrilled to be their partner. What have been our best-selling products this year, and about the build up to Christmas? Using I think what happens with our best-selling products is they tend to be our best-selling products year after year, which is the wines that people love from us, that we've created, that we've really got huge loyalty from customers for. So our Black Pig range, the Beneficio range, the Perez Cruz wines from Chile. They've got you know, there's many great selling wines within our range. What is quite interesting is we did a survey recently to 2,000 consumers about what was the wine that people were most likely to be looking forward to drinking over the Christmas period. And actually the winning wine on that was Malbec. So 19% of people said Malbec was going to be their favoured wine for Christmas. So I'm pleased we've stocked up on Malbec, as well as many other wines too. Can you explain what your open source business model means? Yes, absolutely. It basically means that whilst we have a large number of very trusted winemakers who we've worked with around the world on an ongoing basis, we also don't have contracted supply with any particular vineyard or winery, and because grapes are an agricultural product, and because they vary, the harvests vary in quality and yields from year to year, the ability to go wherever we want to go all around the world to find the best quality grapes at the best price. And then because we're the winemakers as well, and we're working with the winemakers, we can then go and stylistically blend the wines to match the stylistic preferences of our customers anywhere in the world every year from year to year. So it just gives us complete freedom and complete flexibility to make sure we're delivering the highest quality wines at the lowest prices, but deliver the best value for customers every single year without fail. And that open source model has been key to the quality value ratios that we can deliver. So another question. These are the ones that have just come in. So I'm just going to scan through them as we go through. So this was from John saying, "Hi Jay and Graham, well done on the results." Thank you, John. Please can you talk about expansion on beers and spirits and how that's progressing, and what you're looking to do to grow this. Again, I'm not sure if maybe I didn't cover that off enough in the presentation, but really pleased about the way the beers and spirits have started to grow. We doubled the revenue through them this year. I'm really keen that we get the customer proposition right on beers and spirits before we invest huge amounts in driving consumers into those particular sectors. So getting the Beer Save and Spirit Save schemes up and running, which they'll be launching in a couple of weeks. We know that those subscription services, so Wine Bank is obviously an incredibly popular with our service with our most loyal customers. Replicating that type of scheme for beer and spirit customers, I think was a vital step. So we've done that. That also then allows all of our Wine Bank customers and all of our Discovery Club and Just Reds customers to come and enjoy that beneficial pricing as well. So we're trying to give something back to customers who are happy to join one of our subscription services, and we're doing that with that beneficial pricing on beers and spirits. So I think that's key. The other thing is just expanding our exclusive portfolio, and we're working really hard to expand that exclusive range from where they are at the moment. Graham, there's a second part to that question which I'm sure you can see. Do you want to pick up on that?
Yeah, I think we did disclose the sales segment in this actual presentation, so I think you've probably picked that up already. But obviously the beers and spirits sort of doubled in turnover to 1.6 million from 0.8 last year. So it's still a relatively modest part of what we're doing overall, but we'll continue to expand, and we see it as a good growth area going forward.
Okay, thanks, Graham. There's a question here about what progress has been made on partnerships with sister virgin companies and how successful have they been, and what should we expect in the future, and how material is this? And yeah, we work really closely with Virgin Group and with the sister virgin companies, and I've sort of separated those out a little bit because there's two areas to it. And I think I mentioned when I was talking about the commercial business how we had an incredibly successful promotion with Virgin Money this last year, and we're delighted that we'll be working with them again over this next Christmas period. We work regularly with Virgin Media as well. Historically we've done a lot of work with Virgin Holidays. Unfortunately, obviously they weren't very active during the lockdown period, but it's great to see them getting going again at the moment too. Virgin Red is the loyalty program that's been set up by Virgin Group, which encompasses all Virgin businesses, and we've been absolutely key to the launch of and the development of Virgin Red. And it's great that customers from across all the different Virgin businesses can get Virgin Red points with their purchases, and then they can redeem those against a whole variety of different services. And obviously we love the fact that people can come and redeem their points against case of wine, case of beer, or bottles of spirits. And it's certainly been a very successof launch for Virgin Group, having Virgin Red, and we're looking forward to doing a lot more with that loyalty scheme moving forward as well. So yeah, lots of work with them, and also on ESG. It's not just about what we're doing in terms of driving growth with the Virgin business. It's also about working with them to make sure that we can build a better business around for the world as well. The next one question is from John, who's asking about warehouse capacity and how much runway do we have before we need additional capacity. And basically, we can deliver 50% more growth on what we delivered in FY21 before we'll have to look at additional capacity, which sort of fits into the timescales that we built in for the leases on those properties. So we have break clauses on our warehouses in about 3 years' time if we want to action them, and or obviously the opportunity to continue with those particular warehouses and add more space. But I think we're absolutely fine in terms of capacity for the next 3 years. So I hope that answers the question. Sorry, I'm just reading as we go. Yeah, so there's a question here from Anubhav asking, can you please explain what steps you took that caused the fully costed cost per acquisition to go down significantly FY19 to FY21, despite the cost per acquisition actually increasing? Graham, do you want to take that one on board?
Yeah, and I think there's part of that in Kelvin's question as well, in terms of defining what the two things are. The two slightly different measures. Our cost per acquisition, which we sort of call our cost per new recruit, is basically the marketing cost for each new recruit that joins the business. And it's basically the total marketing cost divided by the total number of recruits that we bring in. When we look at the fully costed, what we do with that is we take into account the margin that we make on the recruitment case, plus less any fulfillment cost to actually get that case delivered. So it effectively has the net profit from the recruitment case included within the fully costed recruit. So it's marketing cost plus margin received less fulfillment cost. And obviously those two things can differ normally, and historically sort of up to FY19, they normally landed around the same place. So we're normally quite consistent. In FY20 and FY21, we brought in significantly more pay-as-you-go recruits who generally are being recruited on lower discounts. And that helped actually drive increased contribution from the recruitment activity itself, which meant that the actual costs, the fully costed, was actually a bit lower. Going forward, and in our modelling, we're expecting obviously it to be more like FY19, which is the sort of traditional format we have.
Great, thanks, Graham. Right, another couple of questions. Chris has asked, could you add some granularity to the 2.4 billion addressable market? Yeah, absolutely. So we take the addressable market as being anybody who drinks anything around 3 to 4 bottles of wine a month and would spend £6 or more on a bottle of wine. So we feel that there probably needs to be that sort of regularity of consumption to make wine by the case an attractive proposition. And we don't sell wines under £6. So if people are buying wines below that level, then they don't really fit into our model. So that's where we've got that 2.4 billion addressable market from. It's from people, I say, drinking or consuming 3 to 4 bottles in a household. This is per month, and spending over £6 on those bottles. Chris also asked a question around disruption to shipping, and what assumptions are we making when things return to being closer to normal? I guess the simple answer is we're not really making any assumptions on anything returning to normal at the moment, and we're continuing to ship in advance. We're so in effect, the wines that are coming into our warehouse at the moment are wines that we'll be expecting to be selling during January and February, March of next year. So we're well stocked up for Christmas. We brought everything in to make sure that we're not going to let our customers down. As I said, we've got plenty of wine, and yeah, we're just being prudent at the moment. And I think until we start to see things improve, we'll continue to be prudent to make sure that we continue to deliver our customers the great range and the great service they expect from us. Graham, do you want to just take the one about freight cost affecting margins in 22 as well?
Yeah. It's a good question, that, because obviously the headline numbers and the scare stories about freight rates obviously are out there, and obviously we've seen evidence obviously of people paying £15,000 for a container where they used to pay maybe 2,500 or 3,000. In general, we have not seen that as an approach from any of our freight forwarders. We have seen some inflation in the pricing going through, but it's a relatively minor cost of our wine overall, and it usually depends on where it comes from, but it can be as low as sort of 10 pence, maybe up to sort of 15 to 16 pence a bottle in terms of the overall cost. So we have seen that go up a little bit, but we've also seen softening on some prices of wine itself. We've seen some benefits from FX rates recently because the pound has stayed relatively strong against a number of the areas that we're buying from. So we haven't really seen anything really significant feed into actual wine cost inflation so far. Obviously, we keep an eye on it, and we will amend our pricing and our margins if we need to going forward. But it's sort of it's business as usual, really, for us, I think, is how we describe it. We do see these variations and things go through anyway, but nothing that's really having a major impact on us at the moment.
Okay, I'm just going to take a couple more questions that are left here. One is around what is the trend on behavior of customers about pricing. Highly priced wines are growing or struggling, and what about the margin of those wines? That's from Javier. And the premiumization is something that we've been seeing happening within the wine world for some time in the UK market. And I think if you don't have to go back many years to remember 3 bottles for £10 being a norm at the end of your supermarket aisles all the time, and those have disappeared. So we've definitely seen UK consumers becoming more discerning. We've seen UK consumers wanting to spend a little bit more on a bottle of wine and getting better quality for that. So the high, and I suppose it depends what you call higher price wines, but our core price range that we sell in is really in that sort of £8 to £15 a bottle. We believe that's where consumers get most value. And whilst we'll sell many wines more expensive than that, we believe there's a core of brilliant value wines in that sort of £8.99 to £14.99 price point level, and that sort of area. I think that it's become extremely popular. It's very much where the market's moved into. So I think higher priced wines, if that's the level that we're talking about, are growing. So yeah, premiumization very much a trend that we're seeing. John has asked a question that I'm not sure if I know the answer to. But John, you've asked if the share price continues to not recognise the good work and progress you're all making, will we look to start a share buyback to help kick some life into the price? This shows my naivety, doesn't it, of only just getting involved in the public markets, because I'm not sure what that is. I think I'm supposed to answer the question a little bit. I'll just say that I have great faith that we've got a great business with a very robust business model. If we keep focusing on doing the right things and creating the kind of business that we're trying to create here, with delivering such great quality and such great value with exceptional service, I'm sure that over time the market will give us the value that we deserve on that. Graham, do you want to add anything to that, or is that fair enough?
Yeah, I think it's too early to be considering anything like that at the moment. I think we're keen to explore other investment opportunities going forward. And I think, as Jay said, I think if we do enough of the right things enough times, we will see some liquidity kick into the shares as well, which I think will help. I mean, we've not been on the market that long. A lot of investors don't know a lot about us. Jay and I are doing a lot more investor relation meetings going forward, not just today, but over the next few weeks. And we're also engaging with more brokers and analysts as well, to try to get sort of more interest drummed up and let more people know about what we think is a really good news story. So there's an onus on us to get out there and sell what we're doing as well, so that it brings some value back to our shareholders.
Yeah, and I hope that doing the investor meet company presentation today also plays into that. We're really keen to show retail investors what the Virgin Wines business is all about, and hopefully convince people that it's a good company to back.
Jay, I might just jump in if I may. I know that investor feedback's important. I'm mindful to give you enough time to accommodate that. So firstly, obviously, thank you to all those investors that have submitted questions, and for everyone, Jay and Graham, you seem to answer. There seemed to be another one coming in. So any questions, obviously, that we haven't got round to addressing, I will obviously make those available to you in case you need to put any responses there. As I said, I'm going to shortly redirect investors to provide you feedback. But I guess before doing so, Jay, if I could ask you just for a few closing comments to wrap up, and then I'll send investors to give you their thoughts and expectations.
Yeah, for sure. Thank you, Mark. And I guess more than anything, thank you for giving up your time and coming along to listen to Graham and I talk about the business today. It's been a great year for us. I think with group revenue up 30%, 73.6 million, second year running of 30% plus growth, adjusted EBITDA up 45% to 7 million, increase in our active customer base of 24% over the year, and now having 183,000 active customers, with 80% of them on subscription schemes, and the growth of our commercial gift and beer and spirit initiatives as well. I think hopefully we're really set well for another, and we're very optimistic and excited about the year ahead. So yeah, thank you for coming along, and thank you for listening. I hope we've managed to give you a good overview of the business.
Jay, that's fantastic. Thank you so much. And to Graham for updating investors this afternoon. Could I please ask investors not to close this session, as we'll now automatically redirect you for the opportunity to provide your feedback in order that the management team can really better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of Virgin Wines PLC, we'd like to thank you for attending today's presentation. That now concludes today's session, and good afternoon to you all.